Dear students, in this unit, we are going to discuss on the management of NBFIs or NBFCs, the non-banking financial institutions, its regulation, what are NBFCs, the financial performance of NBFCs, and residuary non-banking companies. Now, let us understand first what is a non-bank financial company. It is also known as non-bank financial institution. These are the financial institutions that offer various banking services, but they do not have banking license. Generally, these institutions are not allowed to take traditional demand deposits readily available as funds such as checking or saving accounts from the public. This limitation keeps them outside the scope of conventional oversight from federal and state financial regulations. NBFC is a company which is registered under the Companies Act 1956 of India and is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, hire purchase insurance business, or chit fund business, but does not include any institution whose principal business is that of agriculture, industrial activity, purchase or sale of any other goods or other than securities, or providing any services and sale and purchase or construction of immovable property. The working operation of NBFC are regulated by RBI, and this is within the framework of RBI Act 1934 and the directions which are issued by this. In November 2017, RBI issued a notification outlining the norms for outsourcing of functions or services by NBFIs or NBFCs. As per the new norms, NBFCs cannot outsource core management functions like internal audit, management of investment portfolio, strategic and compliance functions for KYC norms, and sanctioning of loans. The staff of service providers should have access to customer information only up to the extent which is required to perform the outsourced function. Boards of NBFCs should approve a code of conduct for direct sales and recovery agents. For debt collection, NBFCs and other outsourced agents should not resort to intimidation or harassment of any kind. All NBFCs have been directed to set up a grievance redressal machinery which will also deal with the issues relating to the services provided by outsourced agency. The RBI Act 1934, amended on 1st December 1964 by RBI Amendment Act 1963, in this new chapter 3B, it introduces the regulate of deposit accepting NBFCs. NBFC, along with public and private banks, form the key constituents of India's financial sector. As on October 2022, 9,500 NBFCs were registered with RBI with a total asset size of 42 lakh crore. Now they are playing a vital role in the Indian economy by providing loans to small businesses, consumers, and infrastructure projects, helping to boost economic growth. There are reports that predict NBFCs to register a profit of 15 to 20% and experience robust demand in the next 5 years. NBFCs have stepped into bridge the credit gap by offering credit to individuals and businesses that might not meet the stringent criteria of traditional banks. They have more lenient approach to documentation and collateral requirements, making it easier for the borrowers to access credit compared to traditional banks. NBFCs are not subject to any banking regulations and oversight by the federal and state authorities adhered to by the traditional banks. Investment banks, mortgage lenders, money market funds, insurance companies, hedge funds, private equity funds, and P2P lenders are the examples of NBFC. Since the Great Recession, NBFCs have proliferated in number and type, playing a key role in meeting the credit demand unmet by the traditional banks. Now, let us understand the financial performance of NBFC. With the growing importance of NBFC sector in the Indian financial system, it is reflected in the consistent rise of NBFC's credit as in proportion to GDP as well as in relation to credit extended by scheduled commercial banks. In terms of asset liability structure, NBFC is subdivided into deposit taking NBFC, which accept and holds public deposit, and non-deposit taking NBFCs. Among the non-deposit taking NBFCs are those with asset size of more than 500 crore rupees and or more are classified as non-deposit taking systematically important NBFC. After the regulatory overhaul in the October 2022, NBFCs are segregated into four layers: base layer, middle layer, upper layer, and top layer, based on their size, activity, and perceived level of riskiness. In terms of size, the base level comprises of NBFC ND with the asset below 1000 crores. According to the Reserve Bank of India, it has identified and placed 16 NBFCs in NBFC UL and NBFC TL shall ideally remain empty and will be populated if the Reserve Bank of India perceives a substantial increase in the potential systematic risk from specific NBFC. Over the years, NBFC in India has made rapid strides furthering financial inclusion by offering tailored financial products to the segments undeserved by the banks. In recent years, many NBFCs have assumed systemic significance with interlinkages across financial system. In keeping with the principle of proportionality, the RBI recently introduced scale-based regulation for NBFC, thereby narrowing the regulatory arbitrage between banks and large NBFCs while preserving operational flexibility. An analysis of supervisory data reveals NBFCs residing in the middle and upper layers accounts for almost 95% of the total assets may pose systemic risks. As a result, RBI has prescribed progressively stringent regulatory regimes from NBFCs in these two layers. Now, let us understand what do you mean by residuary non-banking companies. RNBC is one of the categories of NBFC. The principal business of RNBC is receiving deposits under any scheme or arrangement by whatever name called. Deposits are received in lump sum or in installments by the way of contributions or subscriptions or by sale of units or certificates or other units in any other manner. RNBCs are required to maintain the investments as per the prescribed directions of RBI in addition to the liquid assets. RNBC is not an equipment leasing company or a hire purchase finance company, housing finance company, not an insurance company, not an investment company or a loan company or a mutual fund financial company or miscellaneous non-banking company or a mutual fund benefit company. So how is RNBC different from NBFC? The functioning of RNBC is different in terms of the method of mobilization of deposits, and requirements of deployment of depositors' funds as per the directions. Thank you, everyone.